Hey guys, it's Dan here. In this week's episode, I will answer the question, how much risk should I take in finance? Super important question for all of us. So in this video, you will learn three things. First of all, I will quickly talk about the concept of risk aversion. What does it mean, risk aversion? Second of all, I will show you a super important graph showing risk and returns, and I will classify the different assets on it to give you a full picture of risk versus returns. And at the end of the video, I will give you a few tips how you can reduce your risk by still keeping your returns. That being said, ladies and gentlemen, let's start with the video. First, let's talk about the risk aversion. That's kind of a bit of a tricky word. That's why I would like to start with it, because a lot of people make a mistake and think exactly the opposite of what it really means. So what does risk aversion mean? Well, if you have a high risk aversion, it means that you are very afraid of taking risk. In other words, if you convert it into an investment philosophy, it means that you are a very conservative, low-risk investor. That's the first thing. To give you an example, that's going to be the person who hates to lose money, who is very afraid of the stock markets and don't want to enter the investment game because he or she is very afraid of it. That's the typical high risk aversion person. On the other side, you have the low risk aversion, which means that you are very aggressive and you love to take high risks in this case. That would be like the typical day trader, for example, who wants to make money on stocks, for example, by selling and buying stocks on a daily basis. That would be like the super aggressive investor here. So the first question you should ask yourself is, where am I here? Am I more like a very conservative person or more like very aggressive investor? And by the way, that's why if you look at different trading platforms or different investment platforms, it doesn't matter if it's made by humans or made by like a bot or artificial intelligence behind, they will always ask you the same questions. They will ask you about your goals, they will ask you about your age, investment horizon, and if you are a risk taker or no. Why? Because it helps the algorithm or the person in charge, well, to decide where you are here. Of course, if your goal is to maximize your wealth in the next 6 months, then of course you're gonna be somewhere here. And of course, if you want to plan to save for your retirement in 30 years and you don't like to take huge risks, then you're gonna be somewhere here. So that's the first very important thing to understand, is where are you in your risk aversion profile. Is that you have to be comfortable when it comes to your investment commitment, okay? So when you decide, okay, I want to invest, it's a bit like when you are working out and when you start a new diet or something like that, okay? There is no one size fits all approach. It's very individual. You have to know the risk you are willing to take, the return you are expecting, and then once you know where you are here on this scale, now we can look at the different products and returns that are available. Let's put it like this. So the next graph I'm showing you is extremely important to understand. If you understand this graph, you probably get more information, you have more knowledge than most people in finance. So let's get started. So on this, here you see the risk, and here you see the return or the yield, or however you want to call it, but it's a percentage of return, let's say, you are expecting, okay, from an investment. I have put different asset classes on it, and I will explain all of them and why they are how they are. So now let's get started. First of all, as I said, if you are a super risk averse person, so a very conservative investor, you will of course trying to minimize your risk, right? So what is the minimalistic, the least risk you can take to preserve your cash, for example? Of course, it would be your savings account, right? There is something very important you have to understand with the savings account and with all the investments, basically. They are all linked to the central bank interest rate, okay? Right now I'm showing you the central bank interest rate, and this is what is also called in finance the risk-free rate. So as you can see, it changes over time. This is the US Federal Reserve, for example. And as you can see, in the 1980s, there were highs like almost 20%. And not too long ago, like in 2017, it was still at 2.5%. Right now, in 2021, it's at 0.25%, so almost zero, which means, of course, when the interest rate of the central bank is close to zero, it means that, of course, the banks cannot give you much more or much less on your savings account, okay? So if you want to go super conservative, go with the risk-free rate, which gonna be roughly your savings account, and you're gonna get 0.25% per year, which sounds super boring, but of course, if you, let's say, if you're saving for a wedding or a car purchase or whatever in 1 or 2 years, that's probably the way to go, because you don't want to take any risk due to that short amount of time in front of you, of course. Then the next least risky, as you can see, we are very low in risk here, are government bonds. Let's say US Treasuries, for example. So what is this kind of product? Well, the US government, or all the governments in the world, they need money, so they can tap what is called the bond market, and in this case they will issue bonds, which means basically they will ask for money, okay? And you, as a private investor, or myself, we can invest in such a bond, in a government bond, for example, by lending the US government, for example, money. And in this case, it's going to be a government bond. And when you look at the government bond over 10 years, for example, right now it's about 1.5%. That means that if you are lending money to the US government right now, over 10 years, over the full maturity of 10 years, it is guaranteed that you get 1.5% return over 10 years from the US government. And as we all know, the US government has a very low risk of defaulting, right? So it's almost guaranteed that you get your money. That's why it's very low risk, and that's why, of course, the return is pretty low. One thing I forgot to mention at the beginning, and that's basically the most important takeaway from this graph, is risk and return go hand in hand. It's a linear relationship, which means the more risk you take, the more return you are expecting. But what you have to understand is a lot of people read this stuff and they say, oh yeah, I want to let's take big risk because I want to make big money. The problem is, of course, returns can also be very much negative, okay? So if you're taking big risk, you can lose a ton of cash as well, okay? So linear relationship, super important to understand. Let's move on to the next least risky, which will be corporate bonds. In this case, what is a corporate bond? Well, a corporate bond, the same way as a government needs money, companies also need money, okay? Corporations such as Apple, Microsoft, and these kind of companies, they can also tap the bond market and saying, hey, investor, I need some money, can you lend me money? And you can lend these companies money. For example, you can lend Apple or Google or Facebook or whoever, you can lend these companies money, and they will pay you back, of course, with interests over a period of time, okay? In this case, right now, corporate bonds, what you have to understand with companies, not all companies are equal, of course, and there is a classification depending on their rating, okay? It goes from AAA for Apple, which is super profitable with a very low risk of default, to a very, let's say, shaky company, okay? So corporate bonds are very interesting because they give you more return than a government bond, 3%, but roughly 3%, but they are, of course, riskier than the government because a company can go bankrupt, a government such as the US probably not. So you see why you have more yield for more risk here. Again, when it comes to companies, you have to know when you're investing in a bond, what kind of companies are you investing in. The very top ones, like the AAA rated companies such as Apple, for example, or the very shaky ones that have a higher risk of default and, of course, will pay you much more because you take more risk. Then there is a category which is a bit difficult to classify, which is real estate. Why real estate? Because real estate, you can either, let's say, buy a property yourself and own it and then rent it out, for example. Or you can invest in a fund, which is called a REIT, for example, REIT, which gonna be, you invest with a lot of people in a global property market, for example. That could be a video by itself. If you're interested by that, put it in the comment section below. What I want to tell you about real estate, it's much more risky than people think. Actually, it's, as you can see, it's above the bond markets here. And it gives you, let's say, it should give you at least 4 or more % return, depending, of course, if you are investing yourself or if you're investing in a fund. What is very tricky, I would say, with real estate is, especially if you're investing alone in real estate, meaning you are buying a property, it means usually that you have to take some debt. You need a loan probably to buy a place and to rent it out. And that means if you're taking a loan, it increases your risk, of course, because that's what is called leverage, actually. You're leveraging your investment, so you're putting debt on it, which makes it riskier. So keep that in mind. Each time you need to have a loan to invest, well, that makes the entire thing riskier, of course. Then the next category, very famous, the stocks, okay, the stock market. When you look at the stock market, of course, it's riskier than all the rest, because, I mean, let's look at the US stock market, for example. It changes a lot over the year, right? So that's definitely a risky asset. And that's why when you look, for example, at the S&P 500, which is the 500 biggest companies listed and profitable 500 biggest companies in the US, you will see that the return over, I think about the last 50 years or something like that, was about 7%. So you can see that the return is pretty high. Why? Because you're taking kind of a big risk. So here for stocks, it's very simple. As the longer you invest in the stock market, the less risk you're taking, of course, because of course, if you're just investing in the stock market for 6 months, there can be huge up and downs. But if you're investing in the long term, usually it's pretty profitable, as the last 50 years have shown, right? Then we are going into very risky stuff, everything which is related to private equity investments. What is private equity? Private equity is everything that is not listed on the stock market, okay? For example, if you want to buy an Apple stock, or if you want to buy the S&P 500 fund, that's a listed fund or listed company, okay? But private equity are all the companies, usually the younger startups and these kind of things, that are not listed on the stock market. So you are, in this case, you are buying usually startups, riskier businesses, maybe companies that are not good enough to be on the stock market. So that's why you are taking kind of a gamble here. As you can see, risk super high, and profitability or expected return should be at least 10%, because you are backing companies that are pretty risky and the default risk is pretty high, okay? And then the last category, I put them all together, I call it day trading. It can be stock day trading, derivatives, options, or whatever. Everything you buy and sell quickly on a daily basis maybe is of course super risky, because, I mean, let's face it, nobody knows what's happening on one day, okay? If the shorter period you're investing, the more risk you're taking. That's why day trading can be, of course, highly profitable, but it's super risky. So there's going to be very high highs and very low lows. So if you are not the kind of person who likes to gamble, well, probably stay away from day trading. So what I want to show you with this graph here is there is really a linear relationship between risk and return. So as I just mentioned earlier, you have to know how much risk you want to take, and then you can look at the different asset classes here, okay? So that's the first very important point. There are two other things I would like to point out with this super important graph. First of all, as I just mentioned earlier in this video, the risk-free rate depends on the central bank rate, of course. What does it mean? It means if the central bank decides to have a 0% interest rate, everything roughly starts at zero with the risk-free rate and then goes up and up and up. But imagine if you are in a very high inflation country with a lot of risk, then the risk-free rate would be much higher, of course, because the interest rate of the central bank is always linked to the inflation. That's why, for example, in the 1980s in the US, the interest rate from the central bank was about 20% because it matched the inflation, okay? So of course, if you are in a country where you have 20% inflation, that means that your risk-free rate is at 20% and everything else must be way above, because of course if the risk-free rate is already at 20, well, for all the rest you take more risk, so you want to have more return, of course. That was the second point. And my last point was, as you can see on this graph, we have a phrase in finance which says there is no free lunch. There is no free lunch, very simple. You will not get more return if you're not taking more risk, okay? Again, it's a linear relationship. So no free lunch means you have to pay for more security, or you have to take more risk to get more return. So now in this video we have talked about the risk aversion. Are you more like a risk taker or more like a conservative investor? So what is your risk aversion? That was the first part of the video. Second part of the video, we talked about the relationship between risk and yield or profitability. And I showed you different asset classes. But now I would like to give you 2 tips how you can basically get a free lunch. As I just mentioned earlier, there is no free lunch in finance. Besides one thing you should know, actually, and this has to know is related to risk. As I told you earlier, there is a linear relationship between risk and return, which means the more return you want to get, the more risk you have to take. There is one little exception where you can keep the same return but reduce the level of risk, and this is called diversification. So what is diversification and why does it happen? Well, actually the risk can be divided into 2 different risks. There is one which is called the market risk. The market risk is, let's say there is a pandemic and it affects everything you buy, okay? It doesn't matter which stock or which bond or which real estate property you buy. A pandemic, for example, or a financial crash has a huge impact on all of us and on all the financial assets. That's why it's a market risk. That's a risk you cannot avoid. It's always going to be there and every investor lives with it. The second risk, you can avoid it, which is called the specific risk. The specific risk is the risk that is, for example, linked to a company. If I'm only buying one Apple stock, I have a very specific risk related to this Apple stock. To give you an example, if Apple products get banned, for example, in China, it's going to be a huge negative effect on Apple and not the rest of the market, okay? Only Apple would suffer from a ban in China, for example, okay? That means if I'm diversifying, in other words, if I'm not putting all my eggs into one basket because I'm not buying one Apple stock, but let's say I'm buying the entire S&P 500, which are the 500 biggest US companies, in this case I do not have this specific risk for one company because I own 500 of them, okay? So this is how you diversify, and this is how you can reduce your risk by still keeping the same expected return. And to give you the second tip, which is the typical Warren Buffett strategy, he invests in the S&P 500, which is, as I just mentioned earlier, the 500 biggest listed and profitable companies in the US, and he combines it with a buy and hold strategy. What does it mean? It means that you should buy into the market consistently. Let's say on a monthly basis, you put whatever you want, 200, 500, whatever amount you have, you put it monthly into it. It doesn't matter if it's going up or going down. You do it consistently, the same amount all the time, regularly. Plus you do it long term, because of course let's take the example of the stock market. The stock market, as we all know, goes up and down and up and down on the daily basis. But the longer you keep your stocks, let's say over 20 or 30 years, the less risk you have of downfalls, because stocks are always showing expectations from future profits, future cash flows, future dividends, and these kind of things. And companies are getting more and more profitable and pay more and more dividends on average. That's why the stock market in the long run, over 20 years, especially in the US, goes up. So if you follow these tips, which are basically a mix of Warren Buffett and let's say general finance tips, you should be able to definitely know your risk, manage your risk, and invest wisely. Let's put it like this. All that being said, I know that was a very tough video maybe to watch, because there was a lot of stuff inside, but I can guarantee you, if you maybe watch it again or took a few screenshots, you have learned a ton of things, that's for sure. So if you want to keep or if you want to improve your financial knowledge more and more, make sure to subscribe to this channel. I post once a week every Sunday, corporate finance, market finance stuff every week. I'm also on Instagram, Stan the Finance Man, you can easily find me. So if you like this stuff, make sure to like, make sure to subscribe. It takes me about 6-7 hours to research and produce. Yeah, otherwise I just wanted to let you know, enjoy your week. See you soon, guys. Stay safe, stay smart. Bye bye, guys.